And 3, 2, 1. What's up, Jerry?
Hey, what's going on?
We are back together again, at least virtually.
At least virtually. How's the weather up there, my friend?
It's miserable. We tell everybody
I,
you're
I
in
won't.
sunny Florida.
Yeah, I'm not going to tell you how the weather is down here. There's actually a little storm rolling through, but I can't complain.
Yeah, yeah. I mean, it's not horrible, but it's just rainy and cold. I don't know. We might get a look snow for Christmas, though. We'll see. I hope I don't jinx
That's
it.
cool.
It is.
It's been a minute in Virginia that we've had snow for Christmas.
All right, I've been looking forward to this show. Jerry's been telling me all about it, so let's just get right into it. You ready?
I'm ready. So I'm going to tell you right now. Uh, this show might make some people squirm.
You're
Right?
teasing me.
Might be a little bit uncomfortable particularly if you're a Bible investor. Um, there are a lot of ways to play the TSP game, right? We talk about that all the time. At Grow My TSP, our methodology is active management of your account. If you don't know why, if you don't understand that, you will by the end of the show. Okay. So all I'm asking is that you kind of keep an open mind as we go through this.
I got an open
Okay.
mind, but I also like to ruffle
Uh,
feathers.
there might be a little feather ruffle, and I'm just saying, I'm gonna do the best I can. So here we go. So we changed the name, actually, in case you guys didn't notice. We've changed the name to the TSP Weekly Podcast. So here's the podcast for the week. Hope is not a strategy. Okay, it's not a poke at buy and hold. It's actually not something that we made up. Obviously, I'm going to go through um, a piece of a chapter from this book called the Zurich Axioms. We've talked about Larry Williams quite a bit in the past. He highly recommended this book as one of his most all-time favorite books, and I'm going to go through a little bit on the strategy of hope in that book. Then we're going to look at there was a comment stream that was part of a little video that we posted this week, where we were talking about the G Fund. And there's some valuable pieces out of a couple of comments there that I kind of wanted to go through. Um, and that brings us to this idea of buying shares cheap, and why that really all that matters is the dollar value of your account. And then we're going to take a look at market timing, what exactly it is, and how our methodology is different than market timing. And then we'll look at the TSP fund charts. All right. So the Zurich Axioms, okay, like I said, came highly recommended by Larry Williams. He's at ireallytrade.com. We've talked about him several times on different shows. He was one of the few people out there calling for an October bottom and then a strong rally into the second half of 2022, right? So he's pretty much been right on. The book
Can you
was
still get this
written
book? Can
by
you still get it?
I didn't buy the hardcover. It is available on Amazon. I got the Kindle version.
Yeah, of
It's a
course.
great book.
Yeah,
Yeah,
just
it's a
curious.
it's a really really good book. Um, Written by Max Gunther. He was the son of a really successful Swiss. He's from Switzerland, right? His dad was a Swiss stock and commodities trader right after World War II. It's primarily about risk management, and it's definitely well worth your time to read. So I'm going to go over briefly pieces of this one chapter that's on hope. Okay. So I think there's 12 axioms in the book, but the third axiom is on hope. Okay. And this is all quotes from the book. I'm not making this up. When the ship starts to sink, don't pray, jump. The third axiom is about saving yourself when things go wrong, right? So I cut a piece of this out, so it's not exactly word for word, but it's when things go wrong in your trading, and they surely will go wrong. You can depend on it. You can expect that roughly half of your speculative ventures, and when he uses speculative, it's investing for us. It means the same. Half of your speculative ventures will turn sour before you have reached the pre-planned ending positions. Half your guesses about the future will be wrong. Half your judgments of economic forces will be inaccurate. Half the advice you hear will be bad. Half your hopes and dreams are doomed never to be realized. But cheer up. This doesn't mean you're bound to lose $1 for every dollar you gain. If that were true, the whole adventure would be pointless. It is true only of the inept. Successful speculators or investors handle things better. They forge ahead in large measure because they know what to do and unhesitatingly do it when the tide of events turns against them. Knowing how to get out of a bad situation may be the rarest of all speculative gifts. It is rare because it is difficult to acquire. It takes courage and the kind of honesty with a cutting edge like a razor blade. It's the ability that it is the ability that separates the men and women from the boys and girls. Some say it's the most important of all tools in a speculator's kit. And again, this this is the book, and obviously I have the Kindle edition. So, the inability to jump quickly off a sinking ship has probably cost more speculators, investors, more money than any other failing. Getting stuck in a losing venture is the worst money pain there is, says Susan Garner, who recently quit her job at Chase Manhattan Bank in order to devote full time to speculation. So she quit her job at Chase Manhattan to be a full time trader. She's successful now, but she wasn't always. It took her time to learn the techniques, particularly to learn how to lose. In one of her earliest ventures, she recalls she paid $2,000 for a fractional interest in a small suburban office building. Okay, it's not exactly like buying the C fund, but you guys will get the idea. The building's situated in a somewhat sleepy community that seemed at the point of waking up, right? A major federal state highway was scheduled to be built through the region, and the planned route took it along one border of the town. Because the projected highway and certain other economic and geographic factors, everybody expected the town would develop into a thriving commercial center. When that happens to a community, of course, real estate values often rise sharply, including the value of office space. So Susan Garner's speculation looked promising, but as it often happens, the future was postponed. Highway project hit funding problems. Series of announcements spoke of longer and longer delays. At first, the official word was that the project will be postponed for about a year. Then it was 2 years, 3 years, 5 years. Finally, the state official finds the courage to tell the truth. He honestly doesn't know when or if the highway is ever going to be built. Okay, so now she's got a problem. With each succeeding announcement, the fever of real estate speculation cooled a bit, right? There are no daily price quotes on Susan's little piece of a building, right? You can't look at this on a chart like we do with the C fund, but she didn't need the precise numbers to tell that she was getting poorer. She thought about selling her share of this office space, right? There were people who would have bought my share, she says, but I knew I'd have to sell at a loss, and I couldn't bring myself to do it. Okay. Obviously, I highlighted that for a reason. The mental piece of this is the most important thing. I couldn't bring myself to do it. After the first announcement of a 1-year delay in the highway, I tried to tell myself everything will be okay if I just sit tight, right? This was just supposed to be a temporary setback. That's what I kept saying. All I had to do was wait, and my share value would go back up, right? She was convinced her share value would go back up. Then came the announcement of a 2 or 3 year delay. One of the bigger shareholders in the office building now approached her and offered her $1,500 for her share, right? So she paid $2,000 for it, remember? Now this guy comes in and offers her $1,500 for her share. She could not bear the thought of losing $500, which is a fourth of her investment, so she turned him down. He raises his offer to $1,600, and she still says no. As the announced delays stretched toward infinity, the price fell steeply. The lawyer offered her $1,000. A little later, it was down to $800. The lower the price dropped, the more tightly Susan felt stuck. Now I wasn't even hoping to get my $2,000 back. I was angry at myself for not taking $1,500, right, when I could have gotten that. I kept hoping the situation would improve and vindicate my judgment. The lower the price went, the more stubborn I got. I was damned if I was going to sell my $2,000 share for a lousy $800. That should sound really familiar. While her money was trapped in this souring venture, right? Because if you're in the C fund and the C fund's going down, your money is trapped there. Okay. While her money was trapped in the souring venture, other speculations beckoned. She wanted to take a flyer in antique furniture. She liked to look at the stock market. A friend wanted to sell at a bargain price an inherited album of 19th century postage stamps, and this attracted her too. So what she's saying is there are a lot of other things that she could be doing to make money, but she's stuck in this position. The trapped $2,000 was the bulk of her speculating capital, right? For us in TSP, if you're 100% in the C funds, it's all of your TSP account, right? Trapped, the $2,000 trapped was the bulk of her speculating account. She could hardly make a move until she freed it. I finally decided, she says, that it was ridiculous to let money get frozen up like that. She sold her share for $750, and that was how Susan Garner learned the lesson of the third axiom. When the ship starts to sink, jump. Note the wording. When it starts to sink, don't wait until it's half submerged. Don't hope, don't pray. Don't cover your eyes and stand there trembling. Look around at what's happening. Study the situation. Ask yourself whether the developing problem is likely to get fixed. This is a really important one, because how many YouTube videos have we put up in the past couple of months, particularly last week's show, talking about how virtually every financial institution is seeing the stock market go down one level or another over the first 2 quarters of 2023. So ask yourself whether the developing problem is likely to get fixed. In our case, it's no. Look for a trustworthy and tangible evidence that improvement is on the way. Is the Fed telling us that, providing any evidence that things are going to get better along the way?
Yeah, and for us, I mean, we have the charts at least, right? I mean, the example,
right.
It'd be very hard to kind of see those price movements, where her investments were. It's not hard for us. And
Right.
why it's important to bring that up, I think, is because even then, like, people will just flat out ignore it. You'll see that the entire trend has changed. We've gone from bull to bear, what have you,
Yep.
and they're still hoping. They're still hoping. I don't want to get out now. I don't want to lock in my losses.
No.
I know you're going to talk about that in a minute.
Yeah, it's I've gone back and forth with a lot of people this week on Facebook and Instagram, and honestly, I'm not trying to convince anybody to do anything. We all have to make our own reallocation decisions based on our circumstances and risk tolerance. This is a learning site. That's what we're trying to get across, that there's a different way, other than just hoping for the best. Okay, so take action, right? Without further delay. Calmly and deliberately, before everybody else has started to panic, jump off the ship and save yourself. Okay. So yeah, that's hold on, let me get my notes squared away for a second, because I just lost track of my thing. Okay. So hopefully that gives you guys an example of it's obviously not apples to apples with TSP and the C fund, but it's very close. And it's, the book was written almost 100 years ago, and things don't change.
Funny thing is when you started reading that first example about the building being built and then them never getting done, and I was like, man, this sounds like the Silver Line out here in DC.
Right.
Right? We've had a metro station in Ashburn for like 3 years and no trains.
Right.
Anyway, I thought that was kind of funny, but not the same, because, well, I'm sure people were invested in it or are invested in it. We're not, thankfully. All right.
Yeah.
And moving on.
Mentally, though, it's from an emotional perspective, and the way you look at the world, it's the same exact thing. Her example is exactly like, if you're 100% C fund right now, you are stuck, meaning you can't use that money without reallocating it. If you want to get into the F fund because the F fund's going up, you have to take the losses in the C fund to reallocate into the F fund on the hopes that the F fund continues to go up. And we're going to get into a little bit more of that. Okay. So this brings us to a picture that we put out on Facebook and Instagram this week, and it generated a ton of comments. The slide is a picture of math, okay? Nothing more and nothing less. It shows why rule number one is don't lose money. The more of a drawdown you take, right, the exponentially more you need to make on what's left just to get back to even, right? We talk all the time about if you have a 50% drawdown, it takes 100% gain on what's left just to get back to even, right? And forget about down here. If you start losing more than 50%, right? If you lose 60%, so that's only 10% more than the 50% loss, but you have a 50% increase in the amount of gains you have to make up that 10% loss. It gets exponentially more difficult the longer you stay in a losing trade. That's just the math. So people were all spazzed out on Facebook and Instagram that they took it as I was telling people to reallocate to the G fund. I'm not telling you to do anything. This is a chart of math. That's all it is. Okay. We had the crux of what people were saying on Facebook was basically the market always comes back, and that may be true. Here's COVID, right? We had this big run up, and then we had COVID. COVID is probably the worst thing that has ever happened in the last 100 years in the stock market mentally for people, because it was the epitome.
It was a quick rebound, right? That's
right. It was the epitome of buying the dip, right? We came down 35% on the COVID, and then within 2 weeks, I think it was maybe a month, we were all the way back to even, right? And then obviously 2021, huge gains, right? So if this is your most significant market correction, which it was since 2009, this was the most significant correction, and it recovered in a couple of weeks. If that's your come from, then it absolutely why would you ever sell? Why would you ever get out of the C fund? You wouldn't if that's all you understood, right? And none of this would make sense. But COVID was a one-off. Much more likely is what this is, right? So we're going to look at this slide a couple of different times, and I'm going to show you why I picked this particular slide. It's actually part of the definition of market timing in Investopedia, and Investopedia article that we're going to look at in a minute. But I'm going to show it a few different times, and it's really a much better example of what ordinarily happens as opposed to the COVID immediate recovery. So here was the top in 2000. Okay, you had a 50% drawdown, meaning you look from the top in 2000 to the low in 2003. Your drawdown, I'm not going to call it a loss, your drawdown was 50%. So if you are 100% in the C fund up here at the top in 2000, and you wake up in 2003 and you look at your account says $500,000, right? If you have $1 million up here, now you have 500,000 down here. Okay, that took 3 years to happen. Then we have a big rally, right? We recover all the way back up to the prior high. So you're still 100% in the C fund. Now you got your $1 million back, right? Only for the market to roll over again and draw down 58%, right? So now you're somewhere $450,000, let's say. And then the market recovers again. It takes until this month right there, because this is a monthly chart of the C fund, right? I'm sorry, that actually is over here. That month right there, before we get to new all-time highs, okay? That is 2013. It took 13 years before you got to new highs. It doesn't always happen in a couple of weeks, right? They call this the lost decade. Is this what's going to happen? Are we just entering another lost decade? I don't know, and honestly, I don't care because I'm going to be out of the market. If you follow our methodology, you're going to be out of the stock funds when the market's going down, and you're going to be in the stock funds when the market's going up. Because obviously, there is a lot of money to be made here. Because if you did a 50% drawdown here, if you had $1 million here, and you get 500 here, if the market recovers back to even, the 500 goes to $1 million. But if you had gotten into the G fund here and maintained your $1 million, when you get back up here, you have $2 million. So we're gonna talk about that a little bit more in a minute. But I just wanted to point out the idea that recoveries don't necessarily happen very quickly. Okay. All right. So this brings us to I talked about it before. This little video that we put up on Instagram this week about using the G fund to protect against downside risk. Right? If you guys haven't seen it, definitely check it out. It's a good video. This is a screenshot of one of the comments and our responses to that comment. Okay. So the person says every 2 weeks, so I'm right here, right? Every 2 weeks I'm buying shares. I'm not retired. I'm an active contributor. Okay, so he's contributing every payday. You seem to be suggesting market timing by placing in G while returns on others are doing poorly. Me, on the other hand, every 2 weeks my balance usually looks worse and worse, but I'm buying shares at a lower price point, at a discount, and I'll reap the rewards when the economy turns around. Right now, I'm purchasing X shares at $59 every 2 weeks with the hopes the economy will turn around and all those purchased shares will be worth $70, $80, $90 one day. That should sound an awful lot like Susan. There's a lot of hope in there and a lot of not understanding how it works. If it looks worse and worse, it is worse and worse. If the value of your account is decreasing, the value of your account is decreasing. It's as simple as that. Yeah, let me get back to my, so what is he talking about here, basically? Market timing, buying shares cheap, and our response is buying shares cheap is a fallacy, okay? It's actually a twofold fallacy, right? So here's the deal. You have two components of your TSP account, right? You get the core account, and if you've been in the government for any amount of time, your core account is significantly more valuable than the pay period contributions you make, right? So if you have, $1 million in TSP at the top in 2000, and you let it ride in the C fund, your core account by 2003 is now $500,000, right? Your drawdown was 50%. During that time, you were making contributions, okay? The core of your account, the more valuable it is, the more of a hit you're going to take just to be able to say, yeah, but I'm buying shares cheap, right? How much do you contribute to TSP every payday, right? The max for 2022 was $20,500, okay? That's $788 per pay period. So let's round that up to 1,000 so that we can account for the 5% matching and it'll make the numbers simple, okay? $1,000 is 1/10 of 1% of $1 million. The bigger your account gets, the less significant those contributions become, right? That you make every 2 weeks. Your contributions are the money you're using to buy shares cheap, okay? You can't use your core account unless it's in the G fund, right? It's already allocated, right? And it's decreasing in value. you're stuck. It's the same thing as Susan was. You're stuck in that position because it's your core account. If you have $1 million in your core account, 100% in the C fund, right? And the market drops, let's say 25% in a year, kind of like it did in 2022, right? You now have roughly 750,000 in your core account plus 9,000, right? Because we're using the example that you're contributing $1,000 a pay period, right? So you have 750 roughly because you took a 25% hit on your million, plus 9,000 because you're only getting 3/4 of the 12,000 because there was a 25% loss there. So for a total of $759,000 at the end of the year, roughly, right? What if you went to the G fund in January of 2022, which if you were following our alerts, you did, and you put those contributions in the G fund rather than the C fund, okay? At the end of the year, you have $1,030,000, right? Because that million times 1.03 because you get a 3% rate of return in the G fund. So you get $1,030,000 plus the 12,360 in contributions because you were contributing 12,000, right? 1,000 a month plus a 3% gain on that gives you 12,360 on your contributions for a total of $1,042,360. So you are 283,000 better off than the person who stayed in the C fund.
Yeah, I
Okay?
think the key, Jerry, right, is that people like to think of this as a brokerage account, right? And I think you even said it in the comments that when you were replying, like this is a retirement account. It is not the same as a brokerage account. So when we're talking about buying shares cheap, that can work in a brokerage account situation. In your retirement account, you have to look at the balance, right? As you just explained in that scenario, your balance is going down. You're allocated in one fund versus the other. And if that fund is decreasing, your balance is decreasing. It is that simple. And so the only way you can protect against that is to get out of that fund that's decreasing and go to one that is not, generally speaking, the G fund, because we do get a nice little return, in the G fund. And so the only way you can buy shares cheap at all is with your pay period contributions, as you pointed out. So even then, you're buying, if you wanted to go with the whole buying cheap, you're just buying $1,000 if you're maxing out, right? If you're maxing out. So it's a complete fallacy.
Right. That's that, and kind of back to what I was saying. The most important piece of there's the one example where the person stayed in the G fund or the C fund for the whole year, right? If you were in the G fund for the year, now you can use that money to quote unquote buy shares cheap, right? Because you can reallocate it, and now you got $1,042,000 that you could reallocate back into the stock funds when the market starts to turn back up, right? And when that happens, because you were, if we go back to, where's this slide? We were talking about a 25% loss in our example we just had, right? That means the gains are 33% to get back to even, right? So that means if you are in the G fund and you are able to reallocate, that $1,042,000 into the C fund to get that 33% gain. Now you're at 1.385 million. Okay. If you write it out in the C fund, you have your million back, plus whatever the contributions and the gains were. But if just kind of let that sink in. I mean, if you understand what we're talking about here, it's a game changer, and that was only 25%. Imagine if the decline is 50%, right? Which we'll get to the charts at the end, but we just broke 3,900 level, which has been critical resistance and support. We just broke that Thursday, I guess. And the only things left really is whether or not we break through the October low. This chart looks a whole lot like 2008 at this point. And so if you're in the stock funds right now and you've ridden this market down to where it is now, you have a big decision to make. Okay. That's about all I can do on that. If you guys have questions, seriously, we're not trying to tell you what to do. We're certainly not saying you should go out and reallocate to the G fund right now. This is a different way of looking at things. It's not intuitive, but it's a whole lot better than the buy and hope strategy. If you want us to do a show just on this, definitely happy to do it. It might be worth taking the time to just do a really, really deep dive into this whole idea, the whole concept. Okay. So yeah, before I forget, the fallacy, why I said it was a twofold fallacy is because you have two pieces of your account, right? The core account that, the further along you get in your career, the more valuable that is. So the idea that I'm buying shares cheap, you can't use that money, right? That's fallacy number one. You can't use the money in your core account because it's already allocated. The second one, you're buying with your contributions, you're buying a decreasing asset. If you had just bought into the G fund, you're buying an appreciating asset. I can never understand this idea that I like it when the market goes down because I'm buying shares cheap. It doesn't take it too much to scratch the surface of that to see that it really, the math just doesn't work. Okay. All right. Okay. So the other part of his comment there was market timing, right? What exactly, we hear it all the time. Like, you guys are trying to time the market. Okay. What exactly does that mean? So I use Investopedia a lot. Okay. And here's what Investopedia, how they define market timing. Market timing is the act of moving investment money in or out of a financial market or switching funds between asset classes based on predictive methods. Predictive methods. Okay. If investors can predict when the market will go up and down, they can make trades to turn that market into a market move into a profit. Okay. It's using a crystal ball. It's predictive. Timing the market is a key component of actively managed investment strategies, and it's almost always a basic strategy for traders. Okay. Here are the key takeaways from that article. Again, it's based on predictive methods. Okay. If investors can predict when the market will go up and down, they can make trades to turn that market move into a profit. For the average investor who does not have the time or desire to watch the markets daily, or in some cases hourly, there is no good reason. There are good reasons to avoid market timing and focus on investing for the long run. If you guys have been listening to our show at all, we use the 3-year weekly charts. So they're talking about, if you don't have the time, the knowledge or the desire to watch the markets on a daily or hourly basis, I think that's kind of ridiculous. But the big takeaway for me from this was that this is all about predictive methods. Okay, crystal ball.
Which for us, I don't know if you're getting ready to dive into this, but the difference between what we do and predictive analysis is I would characterize it as responsive, right? We respond to the market. We respond to what the market has already done, right? Not what we think is going to happen in the market. If the market turns over and goes past a certain point, it's a confirmed trend change. Like, the whole investment world would agree that everyone that watches the market knows when there has been a trend change, right? We move based on the trend change, which means it already happened. It's not predictive at all. And we joke about, we don't have a crystal ball. We're responding to the market, which is more of a responsive method, right? And that's a totally different approach than market timing.
Right. This week is the best example. I put out different videos every every day this week, and I almost tried to make them alternate. Uh, there are a lot of analysts out there that see that we have hit the downtrend line. Okay, so the S&P 500, we had a high in from the summer rally in August, came back down, went to new lows, rallied off the October lows up into where we were a couple of days ago. Right. If you connected the line of all the tops a couple of days ago, we hit that line, and so there's a lot of resistance there. And there are some people that look at it and say, well, everybody's done. Everybody knows that it should be resistance. And so if everybody sees it, it must not going to be resistance, and the market's going to keep going higher. Okay, that's one thought. The other one is, no, the resistance is there for a reason. It's going to come up to that line and roll over. So I understand. We understand. We're doing this all day, every day. We understand both sides of the argument, and I'm not picking a side because each side is its own crystal ball. I'm going to wait until the market demonstrates what it's going to do, and that happened within the last couple of days, and you'll be able to see it very clearly on the chart. It hit that downtrend line, rolled over, broke below the 20-day moving average line, and it's still moving lower as we're talking. So the point is, most 99.9% of financial institutions, everybody, they have a theory. They have a theory based on macroeconomics or earnings or whatever. They have the theory that this is what the market's going to do. And it's good to know those, all of them, as many of them as you can, because then when the inflection points happen, you can see when the market actually turns, and then you can make a trading decision. So that is probably the opposite of market timing, but that's our methodology. And it's a little bit difficult to put out on 144 characters on Twitter or a couple of sentences on Instagram to get the distinction of what we do versus what market timing is. We haven't figured out a good way to put that out other than to do it like this in kind of long form. But hopefully you guys get the idea. All right, one other thing I want to take away from that Investopedia article, because people talk about it all the time. There was a quantitative analysis of investor behavior. Okay, this report that's available for purchase from Boston research firm Dalbar shows that an investor who remained fully invested in the S&P 500, our index, right, between 1995 and 2014. So the reason I've been using that chart that we've been looking at so far is because of this. That's the chart that they're citing in this report. So if you remain fully invested in the S&P 500 between 1995 and 2014, you would have earned a 9.8% annualized return. However, if they missed only 10 of the best days in the market, the return would have been 5.1%. Okay. Some of the biggest upswings in the market occurred during a volatile period when many investors fled the market. I want to break that down a little bit. If they missed only 10 of the best days in the market, it doesn't say the 10 best days over that time period. It says if they missed only 10 of the best days. Okay, that's a gigantic distinction. So this is a daily chart of this year. Okay, so we have had huge up days. I mean, some of these are monster up days, right? And what's happened every time we've had these huge up days? The market's rolled over to new lows. If you missed this up day and the market rolls over, it cancels it out. It doesn't matter if you missed that up day. This, let's see, this up day right here is probably the best one of, oh no, maybe this one. Probably the best one of the year. So what? It doesn't say the best 10 days, meaning the biggest moves. It says 10 of the best days. And the distinction is we are in a downtrend. Okay. If we were in an uptrend, it would be different. But we're in a downtrend. This is the chart that they're talking about, 1995 to 2014. Okay. Overall, we're in an uptrend. Right? Yes, we had two giant bear markets in the middle of this, but overall, we're in an uptrend. So if you're in an uptrend and you miss 10 of the best days, in this case, it's going to be months. Yeah, your rate of return would be lower. Okay. Let's look at it like this. This is a monthly chart. This month right there, I can't zoom it in. That month right there is a huge up month, right? If you're looking at the top here in 2000, you see the market come down in 1, 2, 3. It's called 3 drives to a bottom. Okay, it's a chart pattern. You see a 3 drive to the bottom pattern. You get a low. You have a recovery back up to the downtrend line. Your next low does not get lower than the previous low. Okay. You get a recovery back up here to the trend line, and now we get above the trend line. That is where you want to get back into the stock funds. Now, if you're trading on a monthly basis, which this chart is, you wouldn't get back in until that month right there, right? Because this is the one that got you above the trend line. So you definitely would not have gotten in at the bottom, right? You would have missed 1, 2, 3, 4 months off the bottom. But by getting in on this month, your risk of the market rolling over is significantly less, right? And what happened? It rallied. So you missed this little piece to maximize your odds of getting this much bigger piece. Okay. Same thing from 2000 on the 2007 to 2009 crash, right? It wasn't at 3 drives to the bottom. It was a perfect Elliott wave. 1, 2, 3, 4, 5. Okay. So we have 5 complete waves. And then we have a V bottom, right? So how do you know when to get back in? Once the price got above the 4 right here, which would have been that month right there, that's your best opportunity to get back in without the expectation of the market rolling over. Okay. So that's how you would do it from a very simple trend line analysis, right? If the market's in a downtrend, you're connecting the highs. When it breaks above that downtrend line, you get back in the stock funds. The other way, when the market's in an uptrend, you're connecting the lows, right? This is not too different from the position we're in right now, right? We had a really big run up in 21, let's say. We came down. We have this trend line. We got below it, came back up, retested it, and rolled back over. So basically, this is a year-long double top, and there was a lot of support here. So you should have been out of the market. That's when I was out of the market. Was that in that month right there? There was absolutely no reason to take this whole loss during the Great Financial Crash. Absolutely no reason at all to take it. You also wouldn't have. I certainly didn't get back in at 666. That bottom tick right there. Absolutely not. I got back in right there. So let's say you don't want to draw the trend lines, right? You're not very comfortable with that. You're a long-term TSP investor. You only want to look at your account once a month. Okay, this is really, really simple, but hopefully it brings home the point. This is the same chart, but instead of having candlesticks, which these are candlesticks, all we did is connect. It's a line chart, so the closing price of every month gets connected to make the line. Okay, and the blue line down here is the 20-month moving average line. Okay. As long as price is above the moving average, you want to be in the stock funds. It came down, tested it, got support here, rallied back up, right? As long as price is above the blue line, you want to be in the stock funds. So from 1995 to 2014, we got from 95 to 2000, to the middle of 2000, you would have been in the stock funds. You would have gotten that whole gain. You would have taken this loss, right? You would have taken that loss and got out when price violated that 20-month moving average line. Okay. And then you stay out until price gets back above it. So what happens? Just using this one technique, and it's on a monthly basis, right? You got out here, you got back in here, you saved yourself this entire loss. You didn't get in at the bottom, but you got back in here and you got this entire gain. I mean, it's such a no-brainer. I can't even, it's just very difficult. So you would get out here. Would you lock in this loss? Absolutely, you lock it in, because when you're below that blue line, you don't want to be in the stock funds. And then the market tanks, comes back up, you buy back into the stock funds here. There's a little bit of churn here. You would have gotten stopped out a little bit here. That's the way it goes. It happened twice in the, from 95 to 2014, 2 times there was a little bit of an overlap. But hopefully this gives you guys an idea. You can use this one tool and look at your account once a month, and you can know whether to be in the stock funds or out of the stock funds.
Okay. Yeah, and if you, our site is, we have a temporary site up right now as we're working on the back end. If those of you that are members definitely know, and if you're new to us and you check out our website, it's kind of a basic website right now. But one of the things that we did have on there before, and we will have again, we had live charts, and we purposely, put it at a kind of a macro scale with the 200, I think 200-day moving average, or whichever it was. Basically, what Jerry just showed you, which means you could literally just go to our website, look at that, and trade based on when those lines cross, just like Jerry just showed you, and it would take nothing to do that. It's so easy to do. We also show you how to set up your own charts. We have a 4-part series where Jerry kind of walks you through. So look for that to come back up next week, and it'll be back on the website if you want to check it out.
I just wanted to point out one more thing about this. This is a game of risk and reward, and risk management, right? The odds, once price gets below that line, it takes a lot of work to get back above it, right? So the odds of it going down are significant, especially since we had this monster run up to it, right? I mean, not even taking into consideration Fibonacci retracements and all the rest of the things that we can talk about. This is just one moving average line. And if you get out here, you save yourself, most of this 50% drawdown. And on this side, it's not the whole thing, obviously, but it's a big chunk of that 58% drawdown. So, and again, it kind of illustrates our methodology. We're not trying to get the top. We're not trying to get the bottom. We're trying to get the area after the top and after the bottom. Okay. Now we don't, I'm using a monthly chart to illustrate this, but it's the exact same thing if you're doing a weekly chart or a daily chart, right? And obviously if you're doing a weekly chart, you're going to reallocate more often than you would if you used a monthly chart. If you're using a daily chart, you're going to reallocate more often than a weekly chart. Okay. All right. TSP fund charts. So This is as of the close on Thursday this week. Okay, so right now the market is tanking worse, so the numbers for the week are going to be a little bit lower than they are here. But this is a very similar chart to the one we just looked at, except it's more current and it's weekly. Each candle is a week of price movement versus a month. And this is the 20-week moving average line instead of the 20-month moving average line. But other than the time frames, you're doing the exact same analysis, just on a different time frame. Okay. So what happened? Here's the bottom from COVID. Here's the gap down, right? That was it would be good if we could show this back here, but this gap down was definitely the time, which is when we got out. We have the alert is up on the website if you want to see what we did, why we got out of the stock funds. I mean, right there. The alert that we put out is up on the website. If you didn't get the gap and you waited to the end of the following week, that's where you were, right there. That was the bottom of the week. And you look at that and you go, I can't sell it here, right? I've taken this huge loss from here to here. I can't sell it. And then within 4 more weeks, you're down here, 35% loss. Okay. But then it only takes a few more weeks and the market comes rocketing back up, which, as we showed, doesn't always happen, doesn't usually happen. But even if you do, if you use this and you follow it that way, if you had gotten out at the end of this week and you got back in when price got back above that 20-week moving average line, you'd be flat, right? You wouldn't have had any of the risk of more downside. So your risk, once you get out here, your risk is zero for all this. And if you want to wait until you get back above that 20-week moving average line to get back into the market, there's where you were. That's where you would have gotten back in. And you are basically exactly flat. But you didn't have to deal with any of this. Okay, so then once we got back above that 20-week moving average line, we got support at that level all the way along until January of this year. Okay, so obviously, if you were in the stock funds, which you should have been all the way along on a weekly basis, by the close of this week, you're getting out. You're getting out of the stock funds. Ever since then, yes, we have a couple of overshoots, right? But generally, the market finds resistance at that 20-week moving average line. It can't stay above it more than a week or two and then rolls right back over to new lows, right? If you connect the tops, it hit it this week and rolled right over. So again, what we were talking about before, this was a critical point. I think one of the YouTube videos that I put up, the title of it was something like "This is too easy" or "This is too obvious" or something like that. Because once you start seeing that we hit this line, eventually that line doesn't work, right? Eventually, and someday it will. Someday, the market will put in a higher low relative to wherever we are. I'm not saying it's happening now, but let's just say the market comes down at 3,600, puts in a higher low relative to this one, and then gets above that downtrend line. This is where you want to get back in the stock funds. There's no guarantees, but the odds hugely improve if you have a higher low and you get above that downtrend line. Because at that point, RSI is going to be 50 and everything's going to be great. And to be honest, the macroeconomic world will still probably look really bad, but as the stock market is a forward-looking animal, it'll turn back around and start going up before the macro fundamentals get better. So anyway, this is the exact same analysis that you can do that we did on the monthly chart, but this is just on a current weekly chart of the C fund. S fund, same kind of idea. Once we got back above the 20-week moving average line after COVID, everything was good. You get some overshoots up here. This wasn't a close below. Let's see. Yeah, if you looked at this on a line, you wouldn't have any closes below that moving average line until right there. So November 2021, the S fund closed below that 20-week moving average line, and it couldn't get back above it until the summer rally, and it managed to stay up there for 2 weeks. For the past month, almost 2 months, it's been oscillating along that 20-week moving average line, right? It does not look like, that's not a good look, right? We came up off this low and we start curving over, and now we're going to get a weekly close well below that 20-week moving average line. So we're going lower from here. Okay, RSI is below 50 and heading lower. We're going lower from here. We're certainly going to go back and retest these lows. iFund has been in a completely different world because the iFund is moving higher because the dollar is moving lower. It has nothing to do with the underlying fundamentals of the stocks inside the iFund. It has all to do with the exchange rate of the dollar. So this kind of reversal candle, very frightening on the one hand. On the other hand, we're still well above that 20-week moving average line. So if the dollar keeps falling, the iFund will keep moving higher. If the dollar starts to stabilize, the iFund is going to roll over. If it gets below that 20-week moving average line, it comes down and retests its prior lows. We're above 50 on the RSI, but it's rolling over. So honestly, if I owned the iFund right here, I don't know that I would sell it, but I certainly wouldn't be adding to any position I had in the iFund. F fund, similar kind of way. It's actually the best looking chart. We got a huge breakout right here through that 20-week moving average line. That was a great time to get, on a weekly basis, a great time to get back into the F fund. The next week, it had a bit of a consolidation, but it was fine. This red week right here, it's consolidating, it's digesting these gains, which is great. It stayed above that 20-week moving average line. It's good. And then this week, we're still in good shape. We're above 50 on RSI and angling higher, right? So it looks good. Yeah, so the chart of that looks really strong. I'm not saying you should go out and buy the F fund right now. I think it's overvalued on the short term, but as we look at this weekly chart, this is exactly what you want to see. If we saw this on the C fund, it's you buying that all day. All right. Okay.
Questions?
That is all I got.
All right, that's enough, bro. That was great, man. You went through a lot of good info. I just kind of let you talk because you were in a good zone, man. If you have any questions,
I mean,
go ahead.
Do I have any questions?
No. I was getting ready to do my spiel about the questions, and I heard you start talking.
I've been putting this together for a while, for the last several days, and I looked at it, came back to it, and kind of reevaluated some things. But the more the market moves up and down along the downtrend line, or a 20-day moving average line, or 20-week moving average line, they're decision points. And generally when that happens, people, certainly what I'm seeing on Facebook and our group and Instagram and the rest of it, people have a position and they want to be right about their position. And my thing is, I understand your position. And if it comes true, I will respond to what the market does based on your correct position. Great for you. If you call the top, that's awesome. If you called the bottom, that's awesome. I have no interest in calling the top and bottom. I want to be able to anticipate it, right? Which we can do because we have trend lines, right? We know when price gets to those points, it's an inflection point. That's when you have to pay attention.
Yep. And if you guys are members, if you guys are members, we're really going to dive into our performance, not only over the last year, but over the last several years. And that will all be on the new site also publicly, like it. A lot of people have been asking for, and I will let it speak for itself. I won't go into it here, but you can see our performance metrics were done by an outside entity. and they are very favorable. I'm just going to leave it at that. And so you can see for yourself. If you have any questions about the show today, ask a question in the comment section wherever you found the video. If you watch this somewhere where there's no comment section, you can always send us a email at support@growmytsp.com. If the question has anything to do with your personal, financial situation, we're probably not going to get into that with you. But it's general questions about the education stuff we put out. We'd love to talk about it. All right, man, great show, and hope everybody is having a great holiday season, and we will see you guys next week.
Yep. Hope your football team, soccer, I'm thinking. Hope your soccer team wins on Sunday.
All right.